Realty Income, the Monthly Dividend Company, is one of the most trusted REITs out there, but lately the stock just hasn't delivered. Over the past 5 years, Realty Income's price return is about minus 10%. The stock is lower than it was half a decade ago, even though FFO per share has kept growing. The business is moving up, but the stock price isn't. And this matters to me because Realty Income is my second biggest investment. I never expected big price gains, but I didn't think the performance would be this weak. With still high interest rates, tenant worries, and slowing growth, a lot of investors are asking, is Realty losing its magic? And is it time to sell and move on? But before making any decisions, you might wanna watch this whole video. Because buried in Realty Income's latest earnings, there's something most people missed, and it could actually be a positive catalyst for the future growth. Let's break it down. Overview. Realty Income, ticker O, was founded in '69, and since then it's grown into one of the largest net lease REITs in the world. The company's business model is very simple but extremely efficient. They buy single-tenant properties, mostly essential businesses, grocery stores, convenience stores, pharmacies, warehouses, and industrial facilities. They rent them out long-term with triple net leases. This means tenants pay taxes, insurance, and maintenance. Realty Income just collects rent, and they use that rent to pay a monthly dividend. Something that the company has done for decades, with hundreds of consecutive monthly payments and years of dividend growth. Today, Realty Income owns properties in all 50 US states, plus the UK, Spain, Italy, and other European countries, giving them one of the broadest footprints in real estate. Their tenants include leading retailers, dollar stores, gyms, logistic companies, and essential service providers. The business is built on predictable cash flow, which is why so many dividend investors love O. Financials. Now let's look at the numbers. REITs use FFO instead of EPS because FFO gives a clearer picture of the real cash earnings. Realty Income has a forward FFO of around $4.20 and a forward PFFO ratio of around 13, which is pretty reasonable for a REIT with this level of stability. Track record for total returns is quite good, except in the recent years. Occupancy has stayed high throughout the year, and the level of diversification is adequate. The dividend comes in a little over $3 per share, giving it a forward yield of around 5.6%. Very high compared to most stocks, but somewhat normal for Realty Income. Short interest is about 4%, which is quite elevated for a conservative REIT. This also signals fear in the market. Market cap sits around $52 billion, making Realty Income one of the largest and most established net lease REITs in the world. Looking at long-term financials, revenue per share has steadily climbed over the past decade, almost doubling from little over a decade ago. Free cash flow per share has also increased gradually, supporting consistent dividend growth. The balance sheet is typical for a REIT, high long-term debt but backed by large, stable property asset and long-term leases. Equity has grown substantially over the time as the company acquires more properties and issues shares to fund expansion. In short, Realty Income isn't a fast-growing company. It's a slow and steady compounding machine built for reliable income, predictable cash flow, and long-term dividend payments. Future. Realty Income's future comes down to three major themes: interest rates, acquisitions, and a new money-making opportunity you might have missed from the earnings call. First, the interest rates. Higher rates make debt expensive, and REITs need debt to grow. If rates stay high for long or go up, Realty Income's FFO growth will stay slow. Acquisition opportunities. Realty Income is still buying billions of dollars worth of properties every year, and they have even said that they have plenty of potential acquisition targets, just not enough capital to buy everything. If they can find deals at high enough cap rates above their cost of capital, growth returns. But if cap rates stay low or borrowing costs stay high, acquisitions become less profitable. Lastly, the new money-making opportunity you might have missed: asset management. Now here's the part almost nobody noticed in the earnings. And honestly, this could become a much bigger deal for Realty Income than people think. or not. Realty Income isn't just a rent collector anymore. They are quietly expanding into asset management, a business where fee income scales quickly and margins are extremely high. So what are they actually doing? Realty Income is now raising money from institutional investors, pension funds, insurance companies, and large asset allocators. The type of investors that want real estate exposure but need a trusted operator. Realty Income already has the scale, the reputation, and the decades-long track record those investors want. Here's the model in simple terms. They raise outside money, they buy properties with it, the same type of properties they already specialize in. They operate those properties exactly as usual, then they collect a management fee, currently referred as 1%, and also they own a stake in the fund. The more capital they manage, the more automatic fee income they receive. So how much AUM do they have so far? As of the latest update, they have around 700 million of outside investor capital, plus 1.4 billion of Realty's own capital. So roughly 2 billion AUM in this new business. So what does this mean for earnings? I built a simple spreadsheet model that shows how different AUM levels translate into additional income per share. The takeaway is that at 1 to 5 billion AUM, the impact is small. At 10 billion, it starts to matter. At 30 to 50 billion, the fee income becomes large enough to noticeably boost FFO per share for the company like Realty Income. Realty Income is not a hyper-growth tech stock. So every incremental percentage point of growth counts. Fee income has the potential to slowly but steadily lift the long-term growth rate. So how long would it take to reach 30 billion AUM then? Now here's where we pull out our little investor crystal ball. This is an estimate, not a forecast, so take it with a grain of salt. Realty Income's fund is brand new, but the company has a strong reputation and huge institutional trust. So it's reasonable to think that they could attract money quickly at the beginning. My rough thought is they could reach 4 billion AUM within the next 2 years. After that early jump, things probably normalize. For comparison, BlackRock grew AUM about 19% per year from the 90s to this day. So let's assume 15% annual growth. At this pace, getting from today's level to 30 billion would take roughly 16 years. But if growth is faster, let's say 25% annually, then it would take roughly 11 years. Still long, but not unrealistic for a small early stage fund. Now let's see how this can affect the intrinsic value. So what is Realty Income worth and how much could AUM fees actually change that? Let's start with the normal REIT business and then layer on the fortune-telling AUM scenario afterwards. Analysts expect AFFO per share to grow slowly, likely in the low mid-single digits, depending on the interest rates and future acquisitions. Historically, Realty Income has grown AFFO about 5.5% per year, but I'm trying to keep expectations conservative. Inflation is still elevated, which normally pushes interest rates higher, but unemployment is also climbing, which puts pressure on the Fed to cut interest rates instead. On top of that, the government is strongly pushing for lower rates. And with the new Fed leader likely coming in, the bias seems to be leaning towards easing rather than tightening. For my base case, I'm using 3.5% growth for the next 5 years and 3% growth after that. And as always, I require 12% return for my money. Historically, Realty Income has traded anywhere from roughly 13 to 22 PFFO, a lot of variation heavily driven by interest rates. Today it sits near to the low end of that range, roughly 13. I still think Realty deserves a slight premium multiple in better rate environments because of its long track record of safe dividends and stable compounding. But with growth slowing towards 3%, I don't see return to the 20x multiples unless the interest rates collapse. So I'm using a 15 multiple as a fair long-term estimate. With these assumptions, and without adding any AUM fee income yet, the intrinsic value comes out to be roughly $57, which is roughly where the stock trades today. Now, let's put our investor wizard hat on. What if Realty reaches 30 billion AUM in the next 10 years? This is pure crystal ball territory, so I'm keeping the math simple. To reflect 30 billion AUM in 2034, which would roughly add $0.26 per share at a 1% fee. So I just tested the growth in the calculator till it fitted the $0.26 per share in 2034. It comes out roughly about 0.55 percentage points of extra FFO growth per year. Not huge, but meaningful. But here's the bigger idea. Realty would now have two different businesses inside the same company. A slow growth REIT and a high growth, high margin asset management arm. Even if the AUM business is still a smaller part of total earnings at 30 billion AUM, the market usually awards higher multiples for scalable fee-based revenue. For example, BlackRock now trades around 22 PE. So in this scenario, I think the valuation multiple could reasonably expand from 15 to about 17. So with these numbers, we could only get 13.5% return on the current price. So the long-term returns would only improve by about 1.5 percentage point per year. Not life-changing, unfortunately, but enough to feel a little bit more secure about Realty's future. So what should we make of all of this? Realty's stock price has been disappointing. Even while FFO per share, occupancy, and the underlying business keeps moving in the right direction, as my second largest investment, I feel frustrated too. But despite the weak share performance, the core business remains solid. Predictable rent, stable tenants, and monthly dividends that haven't skipped a beat. The real challenge is growth. And that's where the new asset management strategy becomes interesting. It won't transform the company overnight, but fee-based revenue that scales with AUM could slowly lift long-term growth. In the base case, Realty Income looks fairly valued around today's price. With meaningful AUM expansion, something like 30 billion over the next decade or so, you could get slightly higher AFFO growth and modest bump in valuation. That doesn't turn O into high-flying growth stock, but it does make the future look a little bit brighter than the past 5 years. For me, this is a buy if you're looking for reliable and safe returns, but I won't be buying more because I already own so much. Except maybe like under $55 it would be too good of a sale not to buy it. And of course, this isn't financial advice. Always do your own research before investing. So, what do you think? Do you think they can grow their AUM to billions of dollars? Let me know in the comments, and give this video a like and subscribe if you haven't already. And as always, do not lose money and safe travels. Bye bye.